Let's get to our stock of the day, largely unrelated to the war in the Middle East, which is a bit unusual. It is Hub24. It is the worst performing stock on the S&P ASX 200 so far this Tuesday. At the time of recording, down, as you can see, 8%, despite a reporting platform net inflows of $4 billion in the March quarter. That's up 9% year on year, with institutional flows weighed down by a one-off outflow, though retail inflows remain strong. Total funds under administration reaching almost 152 billion, that's up 22%. Also exercised a call option to acquire the trustee of its super fund from EQT Holdings, with the deal expected to be complete by the end of the year. And more broadly, we're seeing weakness across the financial platforms and growth stocks today. So let's get some expert analysis of Hub24. Rudy, you own it.
I am a shareholder. I've been for a very long time. And I'm going to correct you immediately. This is a response to the war, because that's why the numbers disappointed. The analysts effectively underestimated how much weak markets would have an impact on their numbers. Now, having said so,
indirectly.
Well, market down, numbers down. That's quite directly.
But not those cost pressures that we're seeing with other companies that are pushing profit warnings because of the war in the Middle East. But I take your point.
But
fair enough.
The impact is on many layers, and so they obviously are a leveraged play on share markets essentially, right? They're also a leveraged play on a market share that is increasingly shifting towards the independents in the sector, or the challengers, whatever you want to call them. And they are the best performing in that group. I've been a shareholder for a very long time. My way of playing this stock, because this is what it does, it always trades on high multiples, because the market is by now convinced it's a very good performer. It executes very well. It still is enjoying the mega trend of what I just described. People are moving away from the platforms operated by AMP, by Westpac, and etc. And they are moving towards basically the challengers, net wealth, Hub24, and full financial planners that make the move. That means always high multiples. It's a relatively small cap company, even though it's obviously in the ASX 200. So the volatility at times can be very, very large. Why is the share price down today? The numbers missed by about 7%. And that's almost exactly what you see in the share price. Today tells you nothing about what's going to happen in the year ahead or the quarters ahead. So I would be saying I stay the course. I mean, selling the stock doesn't even appear in my mind, unless at one stage we're going to a bear market. But I don't think we are going to a bear market. And this type of volatility, when you own this type of stock, that's just what you need to take on board.
All right, so you're happily holding it then?
Yeah.
Phil, and look, I mean, that share price growth has been pretty impressive over the past 12 months, hasn't it?
We were discussing earlier how fund managers sometimes don't sell when they should be selling because they stick to their guns. And I spoke about it on ausbiz, and therefore I can't sell it. I've got to stay positive. Look, as you say, 250+% over the last 12 months.
And that's just 12. That's just 12 months.
Yeah,
if you take a few years, it's much more.
It's been a phenomenal performer. Maybe that was a 5-year chart. Phenomenal performer. Down 7% doesn't concern me. The thing about analysts, they had a very strong previous quarter, very strong. And analysts like to click, copy, drag, and they forget sometimes that there was an anomaly that was positive in the previous quarter, and it was never going to live up to those expectations, and that's what they did today. They had an institutional outflow, I think it was 200 mil, which muddied the numbers a little bit, but it was still a good result. It's just not as good as analysts had forecast, and when you're at 55 times PE, you cannot miss, because the perception is your price for perfection, so it's sold. So we're going to see some analyst downgrades overnight. As Rudi said, it was a 7% miss. Valuations will come down 7%. The quants will tell you don't buy stock after a downgrade. It will probably continue to trade sideways. But as Rudi said, he has picked up some decent market share in the last 12 months, and there's no reason why that shouldn't continue. The market volatility that they experienced in the March quarter will probably continue into the June quarter. So we're into April, the world's no better at the moment. My personal opinion is it will be done, work back from the November midterms. The war has to be done and dusted by November, go 30 June. That gives you time to go around the country saying, look at what I've done, vote for me, vote for me. So no other reason to say the war ends by 30 June, so they're going to have another quarter of volatility. At 55 times PE, come downgrading earnings overnight, with an expected return in the 20s, for a stock this expensive, you really want a bit more juice to put some money into it. But it's a great business with some great tailwinds. I would actually consider it a hold. I wouldn't sell because of today. I would wait for it to pull back further, which it might do in the next 3 months. But I'll be looking to buy it on any weakness, just not today, because I do think the tailwinds it has and the market share it's been winning will continue to grow. We just need markets to normalise, and we're not going to have that for the current quarter. So I would just wait before I bought some. So that's a hold for me.
Markets to normalise. What does that look like?
What does that mean?
Yeah.
When was the last time we saw normal markets?
Yes.
Volatility is the norm. All right, so that's a double hold for our stock of the day, Hub24.